Hello, I'm Ann Kelly. I'm your moderator for today's live stream Climate Week 2020 virtual event, and I'm the Vice President of Government Relations at Ceres. Ceres is an event host for Climate Week 2020, and we're thrilled to be hosting today's session, Investor Expectations in 2021, Setting a Course for Effective Climate Lobbying. I don't have to tell you all how vital this topic is today. Let me give you a warm welcome. It's wonderful to see so many friends and colleagues who have joined us today. I'm struck that we have over 200 people who are interested. I wish we were all in a room together where we could pour a glass of wine afterwards at the usual Climate Week reception. Let's hope that's next year and that we are toasting with things to celebrate. More on that to come. As most of you know, Ceres is a sustainability nonprofit working with some of the largest companies and investors from around the world on some of our greatest global sustainability challenges, including the climate crisis, deforestation, water scarcity and pollution, and inequitable workplaces. We hope that everyone is continuing to stay safe during the pandemic and as we experience some of the most extreme weather across the country. Our hearts go out to everyone affected by the deadly and destructive wildfires in the American West and the hurricanes in the South. What we're seeing in real time is the human and economic toll of a changing and rapidly warming climate, and it is truly devastating. Our session today will highlight the ways in which we can accelerate action on climate change to prevent the next climate disaster through clear, compelling climate policy action. More on that to come, but let me just cover a couple of housekeeping notes first. Please note our session today is being recorded, so we'll be providing all participants with a link to the recording shortly after its completion, so you can sit back and relax, don't feel you have to take copious notes. If you do have questions, please enter them in the chat box that's located on your control panel, and we'll do our very best to answer as many questions as we possibly can, and you can start putting those questions in at any time. And note, there's some potential that due to bandwidth issues, we may experience some challenges. Unfortunately, this is beyond our control. If it does happen, the discussion will pause for about 30 seconds to allow for the bandwidth to readjust. And now it's my pleasure to introduce our wonderful speakers for today. And let me just explain that Adam Kanzer is with us in spirit and in every possible way, except for his video. He's about bandwidth issues, but we're going to hear his voice loud and clear, and you see his photo there with us. So I'll start with Adam. Adam, our old friend, is head of Stewardship, America's BND Paribas Asset Management. Adam has a 20-year track record working on positive social and environmental impact in the investment community. He's been a member of the SEC's Investor Advisory Committee and served on the Public Policy Committee of USIP, which is the Forum for Sustainable and Responsible Investment. Welcome to you, Adam. Morgan Lamana is my colleague, and Morgan is a senior manager for investor engagements focused on the implementation of Climate Action 100+, the initiative in North America that you're going to hear more about. She's responsible for supporting investor leadership on target companies and working with the oil and gas, electric power, transportation, and food and water sectors. She has many years' experience working globally with investors in ESG and sustainable investments. Welcome to you, Morgan. And finally, Catherine Moyer is head of North America Stewardship, Asset Management, Northern Trust. Catherine was also a proxy analyst for Northern Trust and an analyst for ESG and socially responsible investing at Institutional Shareholder Services. In addition, she has a background in ethics, something we very much need on Capitol Hill today, including holding the position of Ethics Program Manager for the Consumer Financial Protection Bureau. A warm welcome to you, Catherine. All right, so you can see we have a dazzling panel and we're going to have a robust, fast-moving conversation. Let me just give a little bit of context and background. As most of you know, the Senate Democrats Special Committee on the Climate Crisis published quite a report in August. I'm sure it was a beach read for many of you. I know it was for me. It included a key chapter on climate lobbying by the fossil fuel industry, bringing attention to the public on the immense amount of hidden influence of this industry when it comes to US politics and the growing interest by the financial industry in this space. At the end, there's an incredible chapter called Dark Money. And it highlights what this influence is and the way it has manifested itself to completely prevent the passage of any economy-wide carbon policy in the last 10 years. climate policy. We're going to zero in on two types of lobbying today. As you know, there is direct lobbying, which is discussions that companies have with policymakers directly, as well as direct campaign donations. And then there's indirect lobbying, which is membership in business organizations and anti-climate groups who lobby directly on behalf of their members. And in our case, many times misrepresent their members. With the Supreme Court decision in 2010, Citizens United, nearly 100 years of limits to political donations and spending by companies were essentially eliminated, which was a boon to indirect lobbying. Sources of contributions could be hidden by funneling contributions through some benign sounding social welfare organizations that could provide misleading information on climate science without reference to who was actually funding this messaging. Our colleagues at Influence Map have highlighted two trade associations as the most influential opponents of climate action, and they are the National Association of Manufacturers, or NAM, and the U.S. Chamber of Commerce. The Chamber has spent over $1.6 billion lobbying the federal government over the last 20 years. They were famously a lead opponent to the Waxman-Markey cap and trade bill in 2009, and they were an opponent to the Clean Power Plan that President Obama put together in 2015. Most recently, they've weighed in, unfortunately, with a negative position on the California clean air rules that are so vital to the progress in that state. They funded a widely debunked study that was critical of the Paris Climate Agreement that was cited by President Trump in part as justification for the withdrawal. Now, I should note that the U.S. Chamber did come out last year in support of staying in the Paris Agreement. But they've still been one of the largest spenders of undisclosed donations on election ads. They've been a prolific litigator. And importantly, the Chamber does not report how much money the fossil fuel industry has directed to it, nor does it list its members, despite the Honest Leadership and Open Government Act, which requires it to do so. So you see the problem. Most of you know it well. We are going to dive in. There's good news here. And the good news are some of the folks sitting right on our panel. Investors are digging in and saying no more. Catherine, why don't we start with you? It's obvious that climate lobbying is an issue for the U.S. It's obviously something that's gotten in the way of progress. Talk a little bit about your sense and why investors are starting to care so much. And again, welcome to you.
Thank you. Thank you for that introduction. So I think to get the conversation started, and we'd, Adam Morgan and I had a prep call last week to talk about this. I think one of the things that we need to recognize is that investors do see climate change as a systemic risk. And so we need to understand how companies are addressing that risk and who's the most prepared to mitigate the financial and reputational risks as they arise with respect to climate change. Corporate influence plays a major role, both positive and negative, in public policy making. So the weaknesses that we see that are in the current climate policy, they pose a risk to the long-term growth value of our clients' portfolios. And so that's probably the first thing that we need to note. What we at Northern Trust care about is the lobbying disclosure itself and the governance of the lobbying activities. Just like we need transparency around a company's CapEx and R&D spending, we need better disclosure on a company's lobbying and political expenditures. I think that the Influence Map calls this the scope 4 of climate disclosure, right? When you combine the disclosures on lobbying expenditures with disclosures around business risks and business strategy, we can have a much better picture of the direction a company is moving and the pace of that direction. This should help support how management sees the risks of the business model and how important those risks are. We also see, as we're beginning to kind of measure companies on their progress, that when companies put these disclosures in place, they can have an impact on a company's ESG ratings. For example, we expect it would show up and influence competitive behavior in ratings models. SASB has a very specific factor that calls on companies in the oil and gas sector to discuss their corporate position related to government regulations and policy proposals that address environmental and social factors affecting the industry. I expect that they probably have similar factors for other markets that are highly regulated as well. I think that one of the things you were hoping was that we would provide a bit of an example for how this kind of, how we see it in the market and why we think it's important. And so in conversation with a few of my colleagues over the last couple of days, we came up with a bit of a hypothetical. So let's say you have a company that develops and sells traditional and alternative fuel. In today's evolving market, we might speculate that they have a competitive advantage over peers because they are investing in alternative fuels. But if they're supporting efforts directly or indirectly on regulations that would, support or prop up traditional fuels, for example, maybe, the rollback of vehicle emission standards, and I'm not an expert, so I'm just speculating here. That could indirectly hinder the ability of service stations, for example, to seek investment to install technology that would sell their alternative fuel product, or encourage states, or discourage states rather, to provide subsidies to open or enable that market to open up within that particular geographic location. So on that hand, you're seeing that on the one hand, they are investing R&D and in CapEx technology for alternative fuels, but their lobbying activity may actually be not helping in this business strategy. Rather, they're helping in one segment, the more traditional fuel strategy, and they're hindering the the more progressive alternative fuel strategy. So we can see, as we're looking as investors, that they are investing towards alternative fuel, and that's great, but the pace of that direction of change is much slower because we can see that their lobbying activities don't really kind of align to that objective. So this is why when we're looking at the need for disclosure, how that disclosure kind of informs us as we're looking at that investment. So this is, I'll pause there and see if Adam wanted to add anything to that discussion.
Thank you, Catherine.
Sure.
That's a fantastic hypothetical. The company's actually working against its own alleged interest. Adam, would you like to jump in?
Yeah, sure. I mean, Catherine, that was a great introduction. And I'm just going to add a few kind of quick points about why investors need to care about I think corporate lobbying in general and corporate lobbying on climate more specifically. I mean, first, when investors look at this stuff and say, well, it's just not material, why would I vote for this? Why would I bother with this? Ask the head of government affairs why they're doing it. Why are companies spending so much money on this if it's not material? This is part of their business strategy. If you don't understand their lobbying efforts, then you don't really understand their business strategy. And as Catherine said, we are talking about systemic risk when we're talking about climate change. When you're talking about systemic risk, government needs to play a role. And so it's critical, if investors are concerned about systemic risk, to understand how their portfolio companies are influencing the rules of the road, which affect all of us, not simply that individual company. I think investors spend sometimes too much time focusing on the specific risks to an individual company from political activity. And there are significant risks, but the bigger risk is the risk to the system as a whole, the risk to the economy as a whole. Now, why don't we have the regulations that we need for climate? Because business has been telling government for so many years that it's simply too costly. The voice of business, the voice of investors is critical. The problem is that it's been sending the wrong message for too many years. And when you talk about the indirect lobbying, the lobbying that goes through trade associations, we often have good companies with very good policies that are allowing their trade associations to contradict their own positions against their own best interests and against all of our interests. So we'll talk a little bit later about this question of alignment, but that has been a consistent problem for many years, and many of us have spoken to companies about it for many years, and we understand you can't always agree on everything, but there are some issues that are critical. The UN the UN Environmental Program puts out an emissions gap report every year. And according to their report last year, critical gaps remain between the commitments of national governments and the actions required to prevent the worst effects of climate change. So it's very clear, governments need to do more. And it's in all of our best interests that they do so. Now, for investors that say, this is playing politics, I don't want to be playing politics with my portfolio. I want to make it really clear, this is not about playing politics, this is about managing systemic risk. And if you don't want to play politics with your investments, you can tell your portfolio holdings to get out of politics. They're the ones that are involved in politics. So at the very least, if you're concerned about playing politics with your investments, you should want to know what your portfolio holdings are doing. You should understand that. So I'll just stop with that.
Well, thanks so much, Adam. And I think you gave us a couple tweetable tweets there. And by all means, encourage our audience to do live tweeting throughout this session. This is not about playing politics. This is about climate risk, period. And absolutely could not agree more. And your earlier one is also a quotable, which is that if an investor doesn't understand the lobbying strategy, they don't understand the business strategy of the company. Thank you. Yes, feel free to tweet. And let me remind our listeners that you can use the chat function to ask questions. Adam, I just want to build on, I want you to go a little further if you would. I know that BNP Paribas was part of 200 investors that published investor expectations on corporate climate lobbying. I think you sent that to about 47 CEOs, major emitters. Can you talk a little bit about that letter and what those expectations continue to be?
Yeah, absolutely. So first off, it actually goes back a little bit farther than that. My firm worked with the Church of England and AP7 and through the IIGCC back in 2018 to put out a set of European investor expectations on corporate climate lobbying, which led to a whole series of engagements with European companies. And I'll get to that in a little bit. We then decided, let's bring it to the United States. So last year, working through Ceres and with Boston Trust Walden, we put together a letter that went to all of the US members of the Climate Action 100 plus engagement. So that's roughly 47 CEOs. The letter was ultimately backed by 200 investors managing $6.5 trillion. So one, great sign that investors are interested and focused on this question of ensuring that we meet the goals of the Paris Agreement, and understanding that public policy is it's a critical piece of that, and that companies can really be playing a very constructive role there. And that's really what that letter was about. The expectations themselves have basically four basic elements. One, we're asking companies to lobby positively in line with the Paris Agreement. And the goals that we're speaking about are the high-level goals. We want to target well below 2 degrees with a target of 1.5 degrees. We want to bring down greenhouse gas emissions as quickly as possible. We need net zero by 2050. We'd love to see more ambitious than that, but that's the essential core ask. The second piece is governance, which I think Catherine spoke a little bit about. We want to see board oversight of the lobbying process. We want to see an internal process to monitor and review both the positions that the company takes directly and the positions that their trade associations are taking on climate. And we want to see consistency. We want to see a process to ensure that both the company and the company's trade associations are aligned with the Paris Agreement. And I think that's the piece that's relatively new here. It's taking essentially a third-party benchmark, the Paris Agreement, and saying, use that as your North Star. Make sure that your direct lobbying and your indirect lobbying is aligned with that, because that's what the global community has said we need to do to achieve, really to keep ourselves stable and alive. The next piece of it is to act when unaligned. So if you find that there are misalignments, and most companies are going to find that there are misalignments, you need to take some kind of action. We have been speaking with companies for more than 10 years about their role at trade associations, and we hear over and over again, well, yes, you're right, we disagree with them on this issue or that issue, but you can't agree on everything. We're doing what we can. Well, I understand that. And we're not dictating what actions companies need to take, but the fulfillment of the Paris Agreement is too important to be sort of swept under the rug and be subsidiary to success on some other issue. It's critical. So we're not saying you need to leave the trade association. We're saying that you need to take some action, and you need to disclose to investors what that plan is. What's your escalation strategy? And the last piece is you need to be transparent about this entire process. So we've had some real success here. Roughly 14 or so large European companies have published reports on their trade association alignment with Paris. Shell, BP, Total, Repsol, Anglo American. I would say in particular, take a look at the BP report. I think, in all of these reports, there's some really interesting detail where they get into specifics about the positions their trade associations are taking and the degree of alignment or misalignment with the Paris Agreement and with the company's views there. And then they discuss what they're going to do about it. And a number of companies have said they're going to leave some US trade associations as a result of that analysis. We filed some shareholder proposals following up on that letter last year. We got a majority vote at Chevron, 53% vote. This is a first-time proposal. So to me, that says investors are ready for this ask and they understand the importance of it. We got a 46% vote at Delta Airlines, 31% at United. So we're going to follow up on that. Morgan's going to talk, I think, a little bit more about that. And I should also note quickly, ConocoPhillips actually just published a report on trade association alignment. I would not hold it out as the greatest report I've ever seen, but I applaud them for doing it. I think it's a first step. And what's important about these reports is that it can serve as a framework for dialogue. So we can sit down with the company and really talk specifics instead of just the sort of broad brush governance conversations that we've been having. We can get into the details now. So I'll probably talk to what's up with that.
Fantastic examples. And I'm wondering, Morgan, if you can build on that a little bit and talk to us more specifically about some examples of success when investors have asked companies about their climate lobbying. And in doing so, maybe for our listeners, you could just give a little bit of context about Climate Action 100+ and its breadth and depth. That would be terrific.
Sure, absolutely. And the examples Adam has given about how well the shareholder proposals did last year, we've looked in Ceres shareholder database and really seen that from 2019 to 2020, support for climate lobbying disclosure resolutions grew. And just in 2020, 10 of the climate action focused companies had lobbying disclosure or Paris aligned lobbying resolutions, and all were supported by more than 20% of shareholders with an average of 36% of shareholders. And why do I bring up that number 20%? Why is that important? As Glass Lewis has even said in its 2020 guidelines that anytime 20% or more of shareholders vote contrary to the recommendation of management, the board should demonstrate some level of responsiveness to address the concerns of the shareholders. And I think that's really what Climate Action 100+ is about. It's more than 500 signatories from around the world, 47 trillion now. Nuveen signed on last week, so maybe 48, and they're really asking the 160 largest carbon emitters, 160 most systemic companies and economies around the world to set net zero targets and to govern a smooth transition to a low carbon economy by demonstrating that their board of directors is skilled in this and that they are disclosing the risks in line with the TCFD. And part of this is lobbying disclosure. So in 2021, we'll finally see all of these 161 companies benchmarked on 10 indicators, which include the net zero targets that they've set, but also how they're actually taking action to align with those. And climate lobbying is part of that. There has been some examples just in the past of companies that have really made progress on the climate lobbying issue. Ford, New York City, filed a resolution on lobbying disclosure in 2019 and 2020. It was a central part of their climate action dialogue. And both years, people from the Comptroller's office went to Ford's annual general meeting. This is an opportunity to speak in front of the full board, other shareholders, company management, and they pointed out that Ford had publicly supported the Paris Agreement, but was giving undisclosed sums of money still to the Alliance of Automobile Manufacturers, which is lobbying against the EPA to reduce fuel efficiency standards. And that Ford was also on the board of the Chamber of Commerce, which at the time was opposing the Paris Agreement, where they potentially really had influence. So really, I think the sustained dialogue between investors and Ford about its misalignment did lead Ford to join California and other automakers to take a stand against federal rollbacks to fuel efficiency standards. We've seen other companies, PepsiCo, really seeing the ask to positively lobby in line with the Paris Agreement. They joined Ceres Lead on Climate to engage directly with policymakers in support of carbon pricing. And then as Adam says, while investors aren't necessarily asking companies to leave trade associations, sometimes when companies do publish their audit of alignment with positions, their own positions and trade associations, and they don't see any scope to influence that association, they will leave, as Shell did with the American fuel and petrochemical manufacturers. And this was a huge focus of engagement from climate action lead investors in Europe. And I do just kind of want to echo what you were saying, Catherine, about the hypothetical example of really investors have been for years saying that retroactive policies damage the company, damage themselves. There was so much money investors invested in carbon credits or, renewable energy. And when those policies are reversed, it does stop capital that could be flowing that would be a benefit for both investors and companies.
Yeah, well, Catherine, in a minute, I want to turn to you. I'm getting a question here about investor interest in reputational risk. And I want to press you on that in a minute because I know you have some thoughts. Morgan, I just want to thank you for highlighting PepsiCo. I'd be remiss if I didn't note that many, many companies in our network engage in positive climate advocacy, PepsiCo being one, all the 330 companies that joined us for Lead on Climate, and of course our members of the policy network. I'm glad you highlighted Ford as well, though. It's a really interesting example because with investor pressure, Ford ended up actually agreeing with the California Compromise, and I think we can trace that directly back to their influence. But you also gave a tweetable quote, Morgan, and I want you to repeat it and say it slowly so people who are tweeting can get that right. I think it's really important that you zeroed in on the Glass Lewis comment about a 20% vote. Can you offer that one more time so people can hear it?
Sure. So it's in their 2020 guidelines. Anytime 20% or more of shareholders vote contrary to the recommendations of management, the board should, depending on the issue, demonstrate some level of responsiveness to address the concerns of shareholders. And I think that is what we see. Some companies might say, well, we're within our legal requirement to disclose, but investors really want to see more than just what is the bare minimum.
Mm-hmm. Absolutely. All right, you heard it here. Look forward to those tweets. What about this question, Catherine? Do investors care about the reputational risk that companies take on, and how have you seen that manifest itself?
I think both Adam and I have some thoughts on this, but when I think about the reputational risks when it comes to lobbying, I mean, on the one hand, we're saying that we want more disclosure and transparency because there's a lack of information. It's true to a certain degree that there's hidden investment. We call that dark money, but there are ways, and we can see this with Influence Map, we can see this with a number of other organizations, that you can, given the time and resources, really try to create a profile of a company and what they're supporting given certain assumptions. So if we assume that they're members of a particular organization, if we assume if we know that organization is lobbying contrary to public opinion on what should be happening with respect to climate policy, then the company begins to have a bit of a reputational risk by aligning themselves and not providing further disclosure around their interactions with that company. As Adam had previously stated, it may not be, in the best interest of the company to completely withdraw from a particular trade association if that trade association is, providing them other benefits. But the question is how are you engaging within that trade association for matters related to climate policy if their policy approach is contrary to, public opinion? And we do see, if you look even at Pew Research Center and other, centers that, measure public opinion on these matters, overwhelmingly Americans want to see stronger climate policies. We see, and particularly young people, really want climate policies. So when I'm thinking about reputational risk, I'm not just thinking about how the company looks by aligning to particular trade associations that have contrary views, but also how they're beginning to look to prospective talent. you know, as an example. So we need to look at the reputational risk, not just, you know, for this particular issue for the consumer, but also in the future of the company and how they're going to be able to attract and retain top talent. When we see examples at companies, I think Amazon is the more recent example, where you've had employees themselves go out and submit a shareholder resolution on the company's practices related to climate, and it did produce change within the company in part, you know, amongst other pressures. But you know, this is something I think that companies need to think a little bit more broadly on.
Mm-hmm. Well, it harkens back to your fantastic hypothetical that you kicked us off with. You suggest a company that might be producing alternative fuels, cleaner fuels on a small scale, but then actually lobbying against the very laws and regulations that would enable that fuel to be used. You suggest bad faith when a company is doing that, that's a knowing bad faith move. And I'm wondering if that kind of a situation is going to lead to a reputational risk, that's going to cause you some pause for sure. And again, if that's out publicly, that's certainly going to affect the company's reputation.
Sure, that's another example of a reputational risk. But companies do have multiple areas in which, you know, that their reputation, you know, is a risk to the business. It can be, you know, in terms of whether, you know, customers want to, you know, buy their product relative to a competitor's, whether, you know, if they're, you know, providing services to someone, you know, from upstream to downstream, I guess is what I'm saying, right? But also just operationally itself. And, you know, I think that's where I'm saying that companies need to think broadly about that impact.
Yeah, absolutely. Adam, I know we can't see your face, so I'm going to go out of my way to re-ask questions of you. Anything that you would like to add to the risk question?
Yeah, I guess I just say, you know, reputational risk is a tricky one. Some companies, it's more important for some companies than others, right? I mean, it's much more important for consumer-facing companies than other companies, and you also have to kind of gauge it against the overall reputation of the industry that they're in. You know, I think some companies say, well, you know, our reputation isn't so great anyway, or consumers don't have much of a choice, or the perception is that we're doing X, Y, and Z anyway. What does it matter? I feel like it can be a conversation starter, reputational risk. I would like us to be talking more about existential risk. That's what we're dealing with climate. I mean, it's a business risk, but it is more broadly an existential risk. And yeah, if you're seen as opposing smart laws and regulations that are going to keep us alive, that could hurt your reputation. But I would rather focus on getting them to support the rules that'll keep us alive. You know, let's focus on the existential risk. Let's focus on the urgency of the crisis, and let's focus on the real risk to their business. You know, I think for too many years we've had companies, as I said before, that will say, no, you're right. We disagree with the chamber, or we disagree with NAM on this policy. But, you know, that's not our policy, and that's not really why we're a member. You know, we're not really that involved on that issue. Well, the problem when you continue to say that is that you run the risk that the chamber or NAM wins on that issue. And that's a critical issue for the business. That's a critical issue for all of us. So I'd like to get us to say, you know, there are certain issues that are just paramount. There are certain issues that are existential, and we need to focus on them. And yeah, there's all sorts of other risks that flow from it, but that's the core. That's the thing that we have to really be directed towards.
Yeah, absolutely, and I appreciate the sense of urgency in your voice. More on this topic to come, and I'd love to spend a little time on both of your views of the oil companies and the American Petroleum Institute. But let me turn to Morgan for a moment, because I know Ceres published the RPE Blueprint for Responsible Policy Engagement last July. And I know it's a new tool for businesses and for investors. Your sense of how this can be used by investors and companies, Morgan?
Yeah, absolutely. And I think it's really useful for companies that are, trying to meet this request from investors, and useful for investors to really keep making that business case and cite peer examples of, how this can be done. So it really asks, the three main pillars are for companies to assess the risk that climate change poses to the company and how to disclose, in its financial filings, how to conduct an internal audit of both direct and indirect lobbying positions on climate change. And really gives, positive examples like Coca-Cola identified in its 10K that climate would cause supply chain disruptions. It asks companies how they can, it shows them how they can govern, systematize decision-making on public policy engagement, and really engage the board on climate policy. And of course, different companies are created differently, but it gives examples of how they can have cross-team collaborations, of management and working with the board to really oversee this risk, and then ask them really to ask how they can state support for climate-based policies. Examples of these policies, directly lobby and how to engage trade associations. I think it also really provides valuable examples of which trade associations are the most detrimental to climate policy and makes the really tangible link between policies and emissions. And it says, as I was talking about retroactive policy and the risk of that, regulatory rollbacks since 2016 are expected to release more than 200 million metric tons of emissions each year. And that's the difference between, putting the US on a path right now to 4 degrees Celsius above what it should be, rather than 2 or below where we really need to be. So I think this is useful for both companies and investors to really realize that trade associations do have a really tangible impact on policy, emissions, and then therefore risk to portfolios of universal owner investors.
Fantastic. And for our audience and listeners, that blueprint, of course, is available on Ceres.org website. It's downloadable and it's free. I'm wondering if anyone on the panel can comment on the ways in which investors are going to hold companies accountable. What are the mechanisms for, I don't want to say spank and thank, either rewarding companies who do the right thing or making sure that companies who don't do the right thing are held accountable. I wonder if any of you have any examples that you can offer, or what are the tools available that investors are willing to use to hold companies to account when they are engaged in this kind of misalignment, engaged in policy that works against their interests, that works against their goals, their statements, the Paris Agreement, and so on. Anyone want to take a crack at that one?
Well, I can start and then I can let Adam fill in. I mean, I think that you also need to look at what an investor can do. And so it was predominantly passive investment perspective that Northern comes from. We are really left with few options, but to engage with companies and in terms of how we are going to vote with companies. We don't have the choice to exit the way that an active fund might be able to do. So in this regard, as we engage with companies, what the market is evolving towards are methods of engaging, seeking, agreed upon changes or reporting, if that is the change that we're looking for. And if we get to a point of frustration or get to a point where we feel that there hasn't been enough responsiveness or attention to the particular matter, you have the choice to begin to vote against. And that can be a vote against a shareholder resolution, which may also just be you're voting against management on a shareholder resolution to send a particular signal and activate your voice in that regard as well. But we also have the option to begin voting against members of the board, the directors themselves, who are responsible and sit on particular committees that may have oversight of these various matters. So if it's the full board, it may be the lead independent director, for example. If it is a board that has a specific committee dedicated to oversight, it may be the chair of that particular committee. Again, it's you have to look at the issue that you're looking at, how serious it is for that particular company, the quality of the engagement and the level of activity that the company is pursuing around addressing the concerns that you raise. And that is going to really influence whether we take more concrete action. But from a passive investment perspective, those are really kind of the two options we have, is just to engage, communicate, and then to take action on the proxy.
And I gather from your comments, do you think investors would generally vote against specific board members who chair a committee?
I mean, we see already that there are certain policies in the market that already do that. I mean, we have, we do it sparingly. We have in the past taken actions against certain companies where we feel there hasn't been enough attention. And I'm not going to call out any particular company on the forum today, but we have done that where we've had engagements with the company and where we are concerned that they're not being responsive enough to either shareholder concerns or there has been, a lack of oversight for a particular risk that is concerning to us.
Okay, that's helpful. And Adam, I'd love for you to answer the same question. And I guess what I'm sensing and I'm wondering is if investors aren't going to be looking for ways to ratchet up that accountability. I mean, I'm sensing, as I said, a sense of urgency, and I'd love to know if we can expect investors to be doing more, getting more creative. And this is why it's so great to have Morgan and her team as a secretariat pushing investors in this direction. But Adam, your thoughts?
Yeah, sure. A few things. I mean, well, first off, of course, as I said before, there's the shareholder proposal route. And as we've seen this past year on the proposals focused on kind of Paris alignment, we got very strong votes. So clearly investors are ready and willing to support that. The Climate Action 100, I will leave for Morgan, but the benchmark letter that just went out does include public policy in it. So we are going to be benchmarking companies on the public policy positions that they take. When it comes to proxy voting, yeah, there are investors that are willing to vote against directors, and we are among them. We have voted against directors for failing to take action on climate. What I'd say is, one, proxy voting in general is kind of a blunt instrument. If you don't convey to the company, this is why we voted the way we did, it's tricky to interpret. The other piece is that so few companies are transparent about the public policy positions they're taking and this alignment process that we've been discussing, that I wouldn't know which companies really to single out. I mean, if you know that there's a company that's really got the wrong positions and they're aggressive about it, then yeah, that's sort of easy. But you can't vote against every company that's opaque about this, because that's virtually every company. So do we have other methods? I mean, one, I would say that all institutional investors that are engaging with companies, and particularly engaging with boards, I would really hope that they would always ask the board, to what degree do you oversee the lobbying process and the political contributions process as well? How are you thinking about that with respect to the Paris Agreement and climate change? How are you thinking about misalignments? This is the company's money that's being spent. You're putting your name out there on the line. These are critical issues. It's the board's responsibility to understand that the company is pushing in the right direction when they're lobbying, and they should be accountable to shareholders on that. So I would love to see investors, making that a standard part of their conversation with directors. I don't think that's the case now, but I would love to see that. I would also like to find ways to work collaboratively with companies and with their trade associations, because we're all facing the same systemic risk here. We had a good call with the Business Roundtable a few days before they put out their new climate statement to sort of give us a heads up. Here's what we're about to say, and I'd love to see more of those kinds of conversations, because we need to get the details right. There's no reason why we should be in opposition to each other on this stuff. We should be able to work together on this.
Well, thanks so much for mentioning the Business Roundtable statement. I'm sure many of our listeners saw that last Wednesday, the Business Roundtable came out with critically important climate principles, and I'd invite either Adam or Catherine to comment on those. Notably, they came right out in support of the Paris Agreement, in support of climate science, and in support of a market mechanism to bring down emissions. It was, in my view, pretty important and a real departure from the U.S. Chamber, but would invite either of you to comment on your sense of its importance. And again, it represents 200 companies in the U.S. Go ahead.
Yeah, I'm happy to take that. I mean, first up, I think it is really important that the Business Roundtable did this, and that this represents consensus. I think a consensus view among their members. Of course, I've got some quibbles. I mean, it began with the sentence that climate. I'm sorry, I've got my phone ringing, and I hope that's not coming through. that climate is changing and human activities are contributing to that change. And how many companies have we seen saying that? And I have to say, every time I see it, it drives me crazy. Humans aren't contributing to climate change. We're causing climate change. We are the root cause. Burning of fossil fuels is the root cause. So don't let companies tell you that we're contributing to it and that this is a natural process. It is not. But okay, they're moving in the right direction, right? They committed to at least 80% reduction in greenhouse gas emissions by 2050, which is not a net zero commitment. So I'm a little concerned about that. But I think their view is that, you know, as we start to move in the right direction, we can ratchet that commitment up. There's a lot of good stuff in there. They're looking for a comprehensive federal policy. They're saying that the patchwork approach that we have in the United States is hurting business. They're looking forward to a portfolio of complementary policies, a price on carbon where it's feasible. It won't always work. They did not make a revenue neutral statement on carbon pricing, which for me is so important. And they discussed the potential use of revenues from a carbon tax or a carbon price, which I think is really important. And they referred to nature-based solutions as well, and investing in those solutions, which I think is also critical. Now, you know, let's see what it means in practice. Let's see what they spoke about duplicative policies. That, you know, there's a potential red flag there, you know. But yes, if there's clearly policies that are not as good as the carbon price, then we probably can get rid of those. But I think a carbon price is critical. I don't think it's going to solve all of our problems on its own. I think we're going to need a carbon price in addition to additional regulations, particularly on methane. And so I like the fact that it was flexible. They're not buying into one particular way of doing it. They're clearly moving in the right direction. And we can now say to Congress, you know, the CEOs of the largest companies in the United States are saying, we need action from the federal government. We need a price on carbon. This is a critical risk. And that's what's so important about it. You know, so we're roughly all moving in the same direction. We can work out the details, but I applaud them for doing this. I think it's obviously long overdue. Great to see it.
Yeah, thank
Adam,
you.
I like your point about, the contributing, because that sounds like you're bringing a dessert to a dinner party. It's not like we're actually making this happen. But, you know, we noticed too in the Business Roundtable statement, it does mention science-based policy, whereas we can see the overall policy isn't aligned with the 1.5 degree net zero by 2050 science. But I just think about there are so many companies as part of that group that do have net zero targets, and it's in their interest to work with their peers to actually make that happen.
Yeah, it's a consensus view. You know, I mean, they have members that are committed to net zero. They have members that are better, you know, that are committed to negative emissions. But they had to reach a consensus. So that's sort of where they came out.
Absolutely. And I noted that when they talked about where the revenue would go, they specifically highlighted revenue going to those who are most affected by climate change. Yeah. And there's another reference in the principles about those who are less economically well off. I think it's really important, and I'm keen to hold them to it, but I thought it was notable, and they do disclose their members, all 200 of them, including some of our allies like BlackRock. And I think we really need to, you know, continue to hold up the principles and pursue them throughout the year. So I give them a lot of credit for that. Great. Another quotable quote, it's not a dessert at a dinner party. Humans have caused climate by burning fossil fuels. You heard it here. Let's make sure we get our language right. Your investors are listening. Morgan, what's in store for next season? What do we have to look forward to? Do you have any predictions that you can talk to us about? And again, you want to remind listeners of the benchmark you referred to. Is that coming out publicly? And if so, when?
Yep, absolutely. So the benchmark framework has been sent to the CEOs of all 160 climate action 100 plus focus companies. So they're now aware of it. And the assessments themselves will come out in February 2021. So that's when investors and everybody, it'll be publicly available, will be able to compare the company's progress on those 10 indicators. You know, for this year, I would expect to see a lot more shareholder resolutions on not just climate disclosure, but actually like the one Adam and BNP Paribas filed, asking companies to align with the Paris Agreement, not just internally. And I expect really, you know, we're talking about what else can they do of the companies that already received over 20% shareholder support for those resolutions for investors to be holding the companies more accountable. You mentioned our ally BlackRock. They disclosed their voting rationale for supporting the Chevron lobbying resolution this year, why they support that, and also, the next steps at a company like Exxon that refused to engage constructively, refused to give investors the disclosures that they had asked for. And they cited voting against a number of directors for failure to make progress on climate risk disclosures.
Well, we're going to look forward with bated breath for that benchmark, and it looks like things are moving in the right direction. I'm getting a question in the chat I want to pitch to Catherine and Adam, and it has to do with Europe. And why is it that we continually be behind Europe and European investors on this front? I don't know who would like to take a crack at that.
Well, I guess I should probably say something about that. Well, working for a European asset manager, it's interesting because when I started to talk to US companies about what the European companies were doing, one of the most common responses was, well, yeah, but they're European companies. And it's like, well, yeah, but they're extractives companies, they're oil and gas companies, they're mining companies. They are your competitors. They're your peers. I don't see why it's so different. The answer, I think, is their stakeholders are different, right? I mean, the European consumer, I think, tends to be more enlightened on sustainability issues, more concerned about sustainability issues. The EU and individual European governments have certainly been far more proactive on these issues. And so the companies need to address that, right? They need to be responsive to those demands. But when it comes down to the bottom line and operating your business, these are all global companies that we're speaking to. I don't see why there should be such a dramatic difference. And we are not, we are talking about voluntary disclosure, at least at this stage. So you don't have to bring that, does the SEC agree kind of question in on this. So I don't really understand it, but it persists, right? Somebody has to lead, I think, is the answer.
Yeah, I think it comes down to what Adam is saying in terms of the fact that Europe is just much further along in terms of its regulatory framework, and companies do respond to regulation, so that they're much further ahead. It allows them to be more comfortable around disclosing information. I think it's just culturally something that's much more internalized amongst their, the clients of investors, amongst the various stakeholders in those particular markets. And I think that has a lot to do with it. But their model is a comply and explain model, and it differs very, very drastically from the US rules-based model around disclosure. So disclosures and the whole philosophy around corporate disclosure in Europe is slightly different than how we see it here in the US. And I think that's a notable difference as well.
Mm-hmm. Absolutely. Well, let me just assure you all and all the investors on the phone, if you're working with companies that are looking to positively engage in policy, I'd be remiss if I didn't welcome them into the Ceres policy fold, where we have a large, friendly family of big tent companies, from Levi's to Salesforce to Microsoft to Stonyfield Farm, the full range, all sectors, working the Hill in a big tent way, in a very safe way, direct and indirect, and very happy to work with them and help them out. I'm wondering if you all, three of you, can talk about what success would look like in this space. What's your vision as we start to make success happen over the next year, the next critically important year? And I don't have to tell this audience just how important the election is, but regardless of how it goes, and obviously we're preparing for both outcomes, what's your sense of how we succeed in this space in the short term? Anyone want to start with that one?
Tough question.
I think it's just don't wait at all. I think investors and companies have been saying, okay, we need a little time to figure this out, but I think this is the key moment for companies, to figure out what they want out of a policy framework, what is really going to work. I know, Catherine, you're talking about the, passive investors have just the most interest also in seeing this really happen and there be an orderly transition, because companies, are going to have they're all going to be exposed to physical risk and transition risk if we don't all work together to get this right. So that would be my message.
Yeah, success is, consensus and agreement on how to disclose the information, how to measure the information, how to evaluate the information, so that, you know, we're being fair and equitable to all parties in the market.
Okay.
Yeah.
Adam.
The West Coast of the United States is on fire. Let's move it. I mean, I think let's stay we are making progress. We're making at least some progress with the companies, and we're making progress with investors. Investors are waking up to these issues. They're waking up to the systemic aspect of this. They're waking up to the policy implications. I'm actually reasonably optimistic on that side. I think the big piece, setting aside the election, which I'm not going to address, is that the voice of business, the voice of investors should no longer be an obstacle to progress. We have to remove that excuse that it's too expensive, it's going to cost jobs, blah, 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 you know, which is what Congress has been hearing, I think, from the largest, you know, most loudest voices for so many years. We're at a point, I think, where it's time to change that message, and I think we've made a good start on that.
Yeah, absolutely. Well, lightning round coming up. I'm asking each of our panelists to take 30 seconds and tell our listeners what's the one thing, companies or investors who are on the line, you can speak to either one, what's one thing they can do in the next 30 days. I'll start by quoting former President Obama and offering his tweet of a couple of weeks ago, where he said, "Vote as if your life depends on it," because it does. Anyone want to jump into the lightning round? Your quick recommendation, next 30 days. What should folks do?
Yeah, I'll give you a quick one. One for investors, you can update your voting policies to vote for shareholder proposals seeking lobbying disclosure, seeking Paris alignment, and seeking political contributions disclosure. And if you can't figure out why, I'm happy to talk to you about that. And if you're, for the corporate listeners, your next board meeting, ask this question of what is being done at the board level to think about policy alignment with the Paris Agreement, and be prepared to speak to your investors about this, because you're going to get questions.
Terrific. Thank you, Adam.
Yeah, I think I have similar items that I would say for investors, make sure that you have materials that you can provide in writing, and in addition to talking points, we're working on materials that we can share with companies. It's good for them to have things to walk away with so that they understand your position and why that's important to you. We hear that a lot from companies. And then on the corporate side, it's important to have that conversation with, you know, at the next board meeting. But in preparation for that, today what you can do is look at your current governance structure. How is management overseeing, you know, the government affairs office, and how does that feed up and reported to the board, and how is the board then, you know, reviewing the strategic plan of the business, you know, with that information that they're receiving. So those would be the ways that I would look at it for the next 30 days.
Terrific. Morgan, you're wrapping us up.
Yeah, and I would say for companies, read Ceres Blueprint on responsible policy engagement, make those disclosures, put them in the public domain, especially if you're a Climate Action 100 plus focus company, because that will be in time to have your score on that indicator for 2021.
All right. Well, thanks so much. I think we could spend another 3 hours on this topic. It is my favorite. I apologize if we did not get to your question, but all of us are available for follow-up. Thanks so much to all of you for taking part in this conversation. And note that you'll receive a recording of this session shortly. And if you like this topic, note that our next session on aligning corporate lobbying with climate science is happening this Friday, the 25th at 1 p.m. And it will include some of our star players on the corporate side, as well as Senator Sheldon Whitehouse, my colleague Veena Ramani, and myself. Really hope you can join us. I hope you have a terrific climate week from here. Thanks so much for being with us, and have a good day. Bye-bye.
Thank you.
Thank you.
Thanks so much to our speakers as well.